Our next topic is income which do not form part of total income. So apart from the topics discussed here, there are few other full exemption and partial exemptions which will be discussed along with a specific head of income. So these are the major heads of full exemptions available under section 10 and various clauses. The first is 10.1 agricultural income. So agricultural income, rent and revenue received, sale of agricultural produce, income derived from farm building. And there are four rules which help us divide amongst the business income and the agricultural income for these four nature of income. These are the percentages. So for example, if the person is into income from growing and manufacturing of rubber, then 65% of his total income will be treated as if it is from agricultural income. That is, it will be added to his total income or for the purpose of taxation only to find out which slab they fall in, and there will be a rebate available for this portion of income. Whereas 35% of such income will be treated as business income. So how to calculate an agricultural income? Conditions. Let us check if the conditions are met by this resident or by this assessee for claiming in agricultural income exemption. Income other than agricultural income should be above the basic total limit, which is 2,50,000 for a 45-year-old, and for 70-year-old it is 3 lakhs. So it satisfies the first condition. The second condition is that the agricultural income should be more than 5,000. So it satisfies both the conditions. So how to compute? Always, as told before, follow this format of writing the assessee name and computation of what has been asked. So since it is tax liability for 2 ages, even total income will be computed. So we are considering all the other income initially. Income from salary and house property. Now this agricultural income has a special treatment. For that, we now first calculate the tax as if it has been included in the total income, and the rebate will be calculated like the net of income plus the basic exemption limit available, which is 2,50,000 in the first case, and on that amount tax will be calculated on regular basis, and then the rebate has been found out. The balance is now tax payable. The calculation will vary between 45 and 70-year-old because there will be a difference of basic exemption. Say if it was a super senior citizen, then 5 lakh should be added to the agricultural income. Now, regarding the other exemptions available, please do go through at your end because it is just a plain reading of English to have a better grip. For example, if you see 1026 AAA, which is specified income of Sikkimese individual. For that, 3 types of income are exempt. So one is any income which is earned within Sikkim, and the second is any dividend or any interest on securities. So these 3 are available for exemption under 1026 AAA. One more condition specified in that section is if a Sikkimese women marry a non-Sikkimese individual, then this section, exemption under this section won't be any more available for that individual. So in the same lines, please do read at least once through all the sections just to understand the nuances of every section available, because this might be there in your MCQ or even as a separate question for say 5 marks where different types of scenario are given, and you will have to verify whether the same is exempted or not. Next is tax holidays for units established in special economic zone. Now, the eligibility, all SSEs who derive profit or gains from an undertaking registered under SEZ Act. So after assessment year 2006-7, if the person has set up an unit and has taken registration in an SEC unit under SEZ Act as an entrepreneur, then this section's exemption is available. So activity is either manufacturing or production of any articles or thing, or provision of any services. So when is this exemption available? First 5 consecutive years, it is 100%, and next 5 assessment years, it is 50%. So over and above this 150%, there is one more available, which is 50 percentage of for few more years, that is for the next 5 years also, on satisfying certain conditions. So what are the conditions? We'll see it with an example. Say an individual has set up his manufacturing unit in SEZ and begins his process on 30/12/2005. So the first condition for verification is that whether this comes within the period allotted. That is, it should have started after assessment year 6-7, like from the assessment year 6-7 and before assessment year 2021. So yes, this falls under the beginning period, that is assessment year 6-7. So up to assessment year 10-11, there will be 100% deduction available on the income. The next 5 years, which is up to 15-16, there will be a 50% deduction available. So if the company or if the individual has to claim a 50% deduction for subsequent 5 years, then they'll have to follow certain conditions. One is that from the start of the first year, after the 10 years of exemption as available under the Act, they'll have to create a reserve account, which is Special Economic Zone Reimbursement Reserve Account. So the same has to be used for purchase of an asset and put to use before 3 years from the date of creation of this original reserve account. So 3 years from assessment year 16-17. Now asset has to be put to use within assessment year 18-19. Say when the assessee fails to follow this, or he has used that reserve account for dividend, for payment of dividend, or purchase of any asset outside India, or for any remittance outside India, then in the same year, that is the year in which the 3 years has lapsed, or where the utilization has been made, which has not been mentioned in the section, then this reserve, which is used, will be treated as profit for the year in that assessment year. The same has been used or where the period has lapsed. Now, for calculation of amount on which the 100% and 50% deductions are available, we'll take a question from RTP May 2020. So now, first we'll follow the format in which the same is to be written. So if there is any specific formula with which the question is going to be answered, then preferably that can be written first. Here in this case, it is profit of unit in SEC into export turnover of unit SEC divided by total turnover. So now first we'll decide what is to be considered as export turnover and total turnover. There is a specific exclusions available in the clarification provided for in this regard, where an export turnover and the total turnover for that matter should not include any freight, insurance and any other expense which has been incurred by the assessee, including all the telecommunication charges for providing of such services or for delivery of the articles cannot be included in the export turnover. So now specifically we are first calculating the export turnover to be considered for the entire calculation, which is 45 lakhs as given in the question minus 5 lakhs which has been used for delivery of goods outside India. So even that has been subtracted. So the export turnover is now 40 lakhs. So this 40 lakhs plus domestic sale of 40 lakhs, our total turnover should be 80 lakhs. Now, why is 50% considered? It is after first 5 years from the date on which the operation has begun. So, operations is begin in the year assessment year 15-16. However, the current year is 2021. So, from this year, only 50% of the total profits can be considered as an exemption. The next is section 14A. This is in relation to the expenditure, allowability of expenditure in relation to exempt income. Say you have bought shares whereby you're receiving a dividend which is exempt. say your since your income, dividend income is less than 10 lakhs, the entire amount will be exempt. So a loan has been brought to buy these shares, and you're paying interest against this. So is this interest now available as an expense against the dividend income earned by you? Certainly no, because dividend income is an exempt income. So rule 8D is where you go for method for determining the amount of expenditure in relation to the income not includable in the total income. How do we find it? It should be aggregate of amount of expenditure directly relating to exempt income. The second case is 1% of monthly average, 1% annual average of monthly average. That is, 1% is annual rate, whereas you will have to find a monthly average of opening and closing value of investments from which the income is exempt. So if there is an investment specifically against which the income is exempt, then that will fall under this first category, which is directly relatable. So if the entire investment income from the investment is exempt, then the entire expenditure against this will be exempt. Whereas there is an investment and any income from that is partially taxable and partially exempt, then this should fall under the second category. So 1% of annual rate on monthly average of opening and closing. The rule is that you have to take aggregate of this, but it cannot go beyond, or it cannot be more than the expenditure itself. So finally, these were the questions which were asked in the previous exam questions. So one is that rule 778, where you have to divide the amount into agricultural income and the business income and find their total income and taxability. And the second case is the calculation of 10AA exemption. However, there is a good amount of chance that even other exemptions can be asked in your MCQs. So just run through it. Hope this presentation was useful for your study. Thank you.